What a farm balance sheet really tells you. Ag producers out there putting together balance sheets at least every year, usually, if not more. Who's using it? Uh, it's a document, it's a form of communication, really. Anything that's in a document is fundamentally a form of communication, but what's it communicating? It communicates to a couple different parties, usually your lender, but also to yourself. The ability to read into what it's telling you can differ by experience. It also differs by the accuracy of the balance sheet. For instance, if a balance sheet is very inaccurate or overstated, then I would form that as a inaccurate form of communication. So, first of all, if your balance sheet's telling you something, you probably want it to be as accurate as you can make it. A balance sheet, at its essence, is demonstrating the ability to absorb risk from a capital standpoint. It shows ability to handle downside. So it shows optionality. It can show how you would handle what if situations, your ability to handle that. It can show how bad things could get with you still being okay. Lenders will, that's what they're basically looking for. They're looking for capacity to handle risk. It starts with your liquidity position because those assets are most easily deployed to handle or do whatever you want to do, either invest in something or take care of a problem. A lot of times in my experience, people tend to list things on their balance sheet that are maybe questionable in how they're looking at it as an asset. For instance, they might want to show like a whole year of rent income on like a hog building or something, which that's not really, it's not really an asset. Um, or there's a tendency also to not show everything you owe people, namely in the form of accounts payable. There's also problems because when you have a market value balance sheet, which is very common in agriculture, that you bought a farm for $500,000 20 years ago and now it's worth 2 million. You listed at 2 million, but you really can't sell it for 2 million and not have a tax implication, so there would be some deferred tax liabilities. So balance sheets are generally in agriculture, they're not actually sound from an accounting standpoint. They're more from a just good enough from a risk standpoint. And usually, when operations are dealing with the amount of debt that they're typically dealing with, if you were borrowing, I don't know, it depends by institution, but like out in California, it's very common that large agricultural producers have accountant review level financials. Lenders don't. It's not just borrower prepared or borrower lender prepared. They're having actual accountants do the review level, not just compilation. It's not that common in the Midwest and in smaller markets to have accountant review level financials. You also would have to be careful to have an accountant that really understands agriculture because it is a distinct form of accounting. Um, the Farm Financial Standards Council is a document that's put together. It's been around since the 80s. It stemmed out of the farm crisis that, in my measure, is kind of the Bible when it comes to agricultural accounting. And it talks through the different levels of balance sheet accounting and what they're good for and what they're not. And to an extent, balance sheets are put together to the degree that they need to be. If a lender has relatively low exposure with the borrower and they have ample liquidity, it doesn't pay to have an accountant review level balance sheet because it's not gonna change your decision. It's not gonna add anything. A balance sheet is a paper reflection of your reality, or it should be. But a balance sheet is, the way I would look at it, is related to statistics. You know, statistics, you try to estimate different things in the population. You're never going to know the true population parameters, but you can try to estimate them as best as you can by sampling. I think of a balance sheet in the same way. Everyone walking around has a balance sheet from the standpoint that maybe a really high level accountant system, or another way to put it would be like God knows your true balance sheet, but maybe whatever you have on paper is 70, 80, 90% kind of accurate of what your balance sheet really is. I was in a class, a ag credit lending class out in California, and the teacher asked, it was a farm accounting segment of the class, and the teacher asked, he said, "Hey, everyone in the room, what's the best day to take a balance sheet on?" And people kind of sat there. And these are experienced. This is not like entry level ag credit people or ag lending people. These are people with like at least 5 years of experience that work at major organizations. People kind of looked around, and someone offered year end, and the teacher said, "The day the business goes out of business, the day the business is no longer, it's basically closed out." What he meant by that is your balance sheet is theoretically the number down at the bottom right normally is where equity is. That's the number that the balance sheet is trying to estimate. If everything were closed out and you were left with just one single checking account with a number in it, that would hopefully be the number, or that should be the number basically. Now it's not going to be the number in a borrower prepared balance sheets. There's tax implications. There's, shoot from the hip or whatever estimates of market value. There's machinery often isn't depreciated or accounted for in wonky ways. Some people appreciate all their equipment. What's interesting to me is that I went to school for 4 years for ag business and economics, and then my first job out of college was a ag underwriting job, and my boss told me to go look at a file. It was on a computer on a software program, and I literally had no idea. I mean, I knew I had accounting, but we didn't really talk about balance sheets that much. It was mainly like accounting, like T accounts and things, and like debits and credits and stuff. To tell you the truth, I hated it, but now I feel like I have a pretty good handle on accounting and how it ties to taxes and stuff. But my point is like I went to school for this stuff and then I worked in the field for years, and it took a long time to like fully grasp what's going on. But you have to understand that from a true accounting standpoint, like if your farming operation had a balance sheet, a statement of cash flows, a net income statement, and a statement of owner's equity, real accounting is having those things actually tie out, meaning that cash enters the business, cash exits the business, you account for that. Capital assets are depreciated, and different things. Basically, you have a statement of cash flows that tracks all the cash in and out, either cash that you borrowed on your line or then paid down on your line, cash that you got from the sale of assets, or cash that you offloaded when you bought assets. These things don't show up on a net income statement. So they're two different things, and all these things need to reconcile out to a margin of error. But that's how real accounting works. So your balance sheet, from a true accounting standpoint, you can't just change market values. You can't wake up one day and say, "No, I'm just going to increase the value of my farm by 5%, by whatever an acre," because that doesn't reconcile to the statement of cash. So real accounting, like if you had actual statements done by an accountant, would be on a cost basis, because that's how you reconcile equity. You can also track contributions into the business. So sometimes when a farm isn't profitable, a lender or someone might say, "Well, they made all their payments, like how are they able to do it?" Well, they don't have the information readily available to say. They may have to ask the borrower more questions. Hey, did you like sell anything over the year? Or like, oh yeah, I borrowed 200 grand from my dad. Oh, okay. Like, yeah, now it like ties together. Like, that would be a contribution if you had like account prepared financials, which 90 whatever percent of farms don't. Again, to back up, most balance sheets in agriculture are market based. They're actually not really accurate from a true accounting standpoint from just that alone, because accounting wouldn't use market based. They use costs and then different depreciation schedules and other rules. Now the thing is that a true accounting balance sheet may not be as useful to a lender in a way, because the reality is a lot of equipment hasn't depreciated. A lot of land is worth a lot more. So if you're actually looking at the risk of an operation, see, the different forms of accounting play different roles. So a lender wanting to make a loan, it is relevant that your land is worth 8-10,000 an acre and not 2,000 an acre. Or if you inherited it, you don't list it at anything. Like, from an accounting standpoint, from tracking all the ins and outs of the money in and out. So basically, there's like, the thing is that lending is not accounting. They're two different things. The art of being a good lender does not necessarily rely on having accountant prepared financials. It relies on a lender knowing what they're looking at and gauging risk appropriately. An operation, no matter what accounting they have. So let me put it this way. If I walked into a bank and sat down and I had a backpack with a folder in it with paper, before laying any paper on the desk, when the banker asked me to show him my financials, does laying different pieces of paper on the desk change the actual reality of my financial situation in real life? The answer is no. That's ridiculous. So out there in the real world, people have real assets, they have real liabilities, they have real risk. They have real risk. They fit a real risk profile. What is on paper as their balance sheet differs in degree to how accurately it reflects their real risk profile. There's different methodologies of doing balance sheets that have trade-offs. I think actually, it's recommended by the Farm Financial Standards Council to actually do kind of a hybrid where you on the same piece of paper you track your cost net worth and also a market value, but then the market value would have an offsetting some sort of estimation of deferred tax liability. So you're not just I'm going to put my land at 10,000 an acre and that puts my net worth at X. It's not really X, it's X minus, if you sold your land for 10,000 an acre, probably some tax. So again, it's just to try to, that tax would be a step in the right direction of trying to estimate the real outcome if you were to sell out, basically, and your real risk, your real ability to handle risk. The other thing, though, is that when you look at a balance sheet, it's one component of someone's risk, but you have to know what you're looking at too. So if you take farmland and you put it up to 10,000 an acre, that's great if you're going to sell it, but most people won't sell any land, and that's not in the question, and that's not really usually applicable to most forms of financing. It's usually not really what you're counting on. So you're usually counting on the operation being able to cash flow something. So what may be more insightful would be how much debt can that land actually support, and a metric that would be interesting to know would be a cash rent equivalent, or some sort of analysis on what type of debt payment per acre, for instance, that the land could support. Because just because land's worth 10-12,000 an acre or something doesn't mean you can borrow 60-70% of it. You might only really be able to borrow 20 or 30% and have it even halfway cash flow. Is crazy. That just speaks to how high values are, and disproportionate to the cash flow that they actually generate. Um, so, and then a balance sheet naturally shows how much, you know, equipment equity someone has or other forms of savings that could offload risk. But the again, the interesting concept is that a balance sheet is a form of communication. There's different methodologies towards putting together balance sheets. All have their merits and demerits, all have their uses, all have their pros and cons. They are a form of communication, and they're trying to tell the farmer something, they're trying to tell lenders something, they're used by third parties, they're used in estate planning. They have many uses, and to the degree that they're accurate helps the situation. I think anyone would vote for, hey, do you want my balance sheet to be accurate or inaccurate? That's not even talking about the tendency for borrowers, or the tendency for people also when they're in a pinch to try to, you know, not necessarily outright lie about their balance sheet, but kind of take a purposefully ignorant approach in a way. And 99 out of 100 people don't have a huge accounting background or don't really understand it fully. So it happens. Balance sheets can be sloppy and, you know, not that accurate, but oftentimes they don't need to be. I'm not saying it's best practice to be sloppy and inaccurate. It's just the reality. Balance sheets are also used heavily to track your change in net worth year over year. A lot of lenders focus on that. Obviously, accuracy is important with that, but without a statement of cash flows and a real statement of net income, it's hard for a lender to really gauge how accurate they are. You have to have a lender that knows the industry they're lending in, and then they need to ask themselves, based on what I know about how the year went, does this change in net worth make sense? You can kid yourself thinking that you're reconciling working capital, but unless you have a statement of cash flows and a statement of net income, you can adjust a tax return that kind of approximate a statement of net income if you have pretty accurate year-end balance sheets. But for the most part, lenders work in a world of approximations. They work in a world of reasonable accuracy. They have good enough information to make the decisions they need to make. And honestly, any prudent lender, there's no point in asking for information past the point that you need. You don't need accountant prepared financials to make a loan to someone that has very little debt and a large asset base. You don't need it. Like, it's irrelevant. So good lenders understand that, and they don't ask for more than what they really need, because you have to ask yourself, if I got this information, what am I really going to do with it? So that's the point. Like, balance sheets are created to the extent that the end user values the use of it. So from a farmer standpoint, they usually want to create a balance sheet that's good enough for what they think they're going to use it for. A lender, the same way. They usually ask for a balance sheet that fits the level of accuracy that they think they need at the time. What can happen, though, over time is that if an operation gets in trouble or is losing money and they need to have a better grasp of what's going on, you may need to increase the accuracy of the balance sheet. And sometimes what happens is that a lender really gets down to brass tacks and scrutinizes every single thing, and they go through it in detail. They try to cross-reference a checking account. Then they realize that for years they've been working on pretty inaccurate information, or the farmer says, yeah, that's not really accurate, or that's not really a prepay. I actually still owe that. So what I've seen is that a lender's working with fairly inaccurate information. Times get tougher. They sharpen the pencil and they realize it's even worse than they thought. That can happen. But the other thing I would add is that the goal of a balance sheet isn't to maximize your net worth in your head or on paper. So farmers that are really sensitive to their net worth and they really fight every single thing, they want to value everything as high as they can. They look at doing their balance sheet as they come in, and I mean, they're going to if the lender says, I want to depreciate your condo, oh no, I saw there was an auction over in Illinois where one just like mine went for, hell, it went for 30,000 more than if anything, I'd increase it. I mean, they are just not receptive to any form of depreciation. They want to list their land at the highest possible value that they can somehow justify. And the whole time they're just eagerly awaiting to see what that equity number adds up to. Well, then, that's kind of like a feather in their cap, or they kind of walk out of the bank with their chest puffed out and their shoulders back and head held high. And they got that piece of paper in their hand. But it's a piece of paper. Again, the piece of paper is trying to reflect what's actually out in the real world. So what you dream up on your piece of paper in the bank may or may not, it doesn't change reality. So the piece of paper is trying to mirror reality, and trying to maximize the piece of paper doesn't necessarily change anything in reality. It just changes what's in your head. The other thing, it can actually be a detriment, because in economics, there's a thing called a wealth effect. So when you become more wealthy, you tend to do different behaviors. You tend to spend more. You tend to consume more. You change your behavior if you have more wealth. So if someone looks at their piece of paper and through creative brainstorming, they were able to get their net worth as high as they possibly could justify when they walk out of the bank, how do you think they're going to act going forward? Are they going to be more careful? Are they going to be more risk averse? Are they going to be more apt to say, I can buy the $90,000 pickup. God, look at our net worth. What are we worried about? So a balance sheet can influence decisions in that way, and it does. It does, even if it's subconsciously. So you're not doing yourself any favors by trying to just maximize your balance sheet. And lenders see through it too. In fact, lenders will usually just pencil out what they think, even if they don't put it anywhere. They'll actually do math on a sticky note and be like, okay, I'm still safe, even though the balance sheet is way overinflated. I'm kind of keeping an idea of what it really is. So I would just point that out. But again, a balance sheet is trying to mirror reality, and the closer you can to do that, the better off you likely are. If you found this video useful, please like and subscribe, share it with your friends who could also use it.